Hello, everyone. My name is Clément Gignac, Chief Economist with iAIM Financial Group, and welcome to this eighth edition and the last edition, believe it or not, to this iAIM Weekly Fall Series. Yeah, it's a fall series because guess what? Yesterday here in Quebec City, it was a record uh, close to 15 degrees. So it was surprising for early December, I would say. Hoping that you have enjoyed that series. We can talk about that later on, maybe. But we have the format. It's a conversation. The previous edition has been our colleague portfolio manager, and this week I have as well a colleague portfolio manager, very well-known economist as well, Sébastien McMahon, and we will talk about, in fact, the asset mix, asset allocation, outlook for 2021 and as well the RA managed solution, because since Sébastien is a lead portfolio manager. You know Sébastien, but I introduced properly, like the other guests I have received. So Sébastien have 15 years experience. He have started the finance department. He have done experience in the Desjardins Group, as well on the regulator, Autorité des marchés financiers. And he joined IA, in fact, in January 2013. It will be 8 years with me next month. I'm so fortunate to have Sébastien who has accepted to join me when I arrive at RA. So Sébastien, not only a senior economist, but in fact, since early 2019, now he's a lead portfolio manager on the different funds, including a focus fund and selection fund. So it's the dessert. So I keep you, Sébastien, for the dessert. So it would be a different format than the weekly capsule, probably much less on the economy, much more on the asset mix, and talk about, in fact, the managed solution. And we'll have time for Q&A as well. So thank you for accepting this invitation, Sébastien, and you have the floor.
Thank you, and it's been a very very fascinating 8 years that we spent together, and there's more collaboration to come. So, yeah, as you mentioned, we are producing lots of material, and you follow us on the weekly economic reviews on the weekly basis. So we won't be repeating everything we said there. ia.ca/economy, you have everything there, but just wanted to bring the big picture for the economy and then look at where to invest in 2021, and then we'll dig into the managed solutions. So a comment that we hear a lot is that, well, I am nervous about next year because I'm seeing the local stores, the local restaurants that I see around me having a hard time now. So not quite certain about the economic prospects for next year. Just want to bring back what's the big picture here. The big picture is that 2021 is looking pretty good on economic growth. This is from the OECD. We've used that many times in the past, and we're fortunate because they updated their forecast yesterday. So this is from yesterday's publication in the OECD. As you can see, we are here with the red arrow. This is where we are. The gray line on top was the forecast that they had before we even heard about COVID. After that, we did have a very sharp contraction in the first half of the year, and we rebounded. And now we are still rebounding, but with less momentum. But we are looking at the year of the vaccine. So 2020 was the year of the virus. 2021 will be the year of the vaccine. So you have three scenarios here. Downside is pretty much going sideways, but the other two are showing growth because we'll have a vaccination campaign next year. And a vaccination campaign at the end of a pandemic, you cannot imagine a bigger stimulus than that. And in fact, last year when we did these shows before there was a pandemic, our forecasts based on how the pandemic would affect the economy would have probably been wrong because we've never experienced anything like that, and we haven't ever experienced a vaccination campaign following a global pandemic either. So the guesses are that we'll have positive return next year, but we could be in for more upside. Less upside, we'll see, but we are optimistic about next year. And when we talk about the vaccines, there's not only one, as you know, there are many. And this morning, on December 2nd. England was the first, or rather the UK was the first country in the world to approve the Pfizer vaccine, and they will start vaccinating people in the next few days. So it's not a few weeks or a few months, it's in a few days. In the US, we're talking about December 12th to December 18th as being the first wave of vaccination. Probably it will be people that work in hospitals and in older people care. So this is where we are already, and there are treatments also. The Eli Lilly treatment below got the clearance in the U.S. So we are already at that juncture. So we'll see what it holds for the future, but we are optimistic about the impact. If we look at 2020, the fiscal and monetary stimulus on the left, as you can see, the largest fiscal stimulus among developed countries was Canada. So we added 16% of GDP stimulus, but there was lots of stimulus by everyone. So there's lots and lots of money in people's pockets. And on the right, we always love to use this little cartoon of Mr. Powell, the chair of the Fed, who's just putting liquidity in everyone's pockets, Wall Street, Main Street. So liquidity always goes somewhere, and it's going to be, again, a good tailwind for the markets in 2021 and years to come. Just remember, we were in this situation in 2009, 2010. So there were still some risks, there were some volatility, but when the central banks are pumping liquidity, well, it helps the market because liquidity always goes somewhere. The result, a few lines here, but a good chart about the amount of pent-up demand that you have. The red line is the real compensation. So people have lost their jobs and regained their jobs. So this is how the wage growth of the Canadian population evolved through the year. So it was more than compensated, as you can see, by government programs, because the real disposable income rose. And I never thought I'd see a recession where you had people with more money in their pockets than they had before. But this is what we had. And
this is unprecedented. Sorry to interrupt you, but this is unprecedented, and we have never seen that.
Never seen that before. And what this means is that, yes, the labor market needs to heal. So it will take a while. There are some real damage there. Some people have lost their jobs maybe permanently, and they need to reform or maybe even to move to find new jobs. But overall, when you look at the global Canadian economy, and this also applies to the US economy in most developed countries, you have people having the checks that they got were saved. So the savings rate is pretty high, and we know that when we will be reopening the economy, there will be lots of pent-up demand in the pipeline. So that's a good tailwind for 2021. So always some upside and some downside risks. So the biggest downside risk, the first one on the left, will we keep this one under control, the second wave? So we know that 2021 will be a year where the economy will be running, and we are running right now. So will we walk into 2021, or will we fall flat on our face? So in the short term, we need to keep this wave under control, but the vaccines are just around the corner. We know that the upside risks, efficient vaccines, this seems to be where we are. In Canada, Mr. Trudeau mentioned that about 8 to 9% of the Canadian population will be vaccinated between January and March, and by the end of September, it should be 70% of the population that's vaccinated, which should be enough to give herd immunity. So this is the plan. Lots of uncertainty, but this is where we are. So the vaccine and the COVID situation are still very important, but we know that with a lot of stimulus that we have and a surge in innovation that we have from our new ways of doing business, should be helpful in 2021 and beyond. So that was the wrap up of the economic part. If we look now at the markets, the question everyone is wondering, especially in early December, is where to invest next year. So 2021. Where some of the pushback that we get, that anyone can give, is that, well, the market seems overbought right now. So when we look at the market, it seems to be expensive. So here it is, a chart from Strategas, a firm that we are subscribed to for their research. It looked at the percentage of stocks on the S&P 500 which trades above its 200-day moving average, and now it's in the 10th decile. So it's 93% of the S&P 500 that trades above its 200-day moving average. Remember that 200 trading days, that's pretty much a whole year. So that compares to pretty much all of the COVID situations. So it's not unnatural that we see something like that. It means that we have breadth. And when we have breadth in the market, this is usually very constructive for further gains. And what this shows here is that when you have such elevated breadth, well, the possibility of having positive returns over the next 12 months, so that covers almost all of 2021, is at its best and by far. So the average stock is participating now in this rally, and this is a very, very good thing. If you look at valuation, valuation seems elevated for the S&P 500. You see on the left, this is the price to earnings ratio. It seems comparable to the 1999 dot-com bubble, but you need to now look at how the market is composed. And the market now is composed in the US. This is for the S&P 500. The biggest leaders are very heavy. So you're talking about Facebook, Amazon, Apple, Microsoft, Google. You can also add the Netflix in there, and soon you'll be able to add Tesla, which will become one of the biggest companies on the S&P 500. So remember that when you look at earnings are the profits. So you have all of the deductions for reinvestment in there. So the best example is Amazon. Amazon is one of the companies in the world that makes the most money. But when you look at the profits, sometimes it makes no profit at all because it's always reinvesting into its future. So that pushes its price earnings ratio up, and that distorts on the level of the index. So on the right, as you can see, the biggest stocks on the S&P 500 gained 48%, and this is as of November 9. But I thought the chart was interesting, so it dates by about a month. But the other remaining 495 companies pretty much going sideways all year. And this is what we're starting to see. We're starting to see, since we had the announcements on the vaccines, well, the stocks that were unloved, that we had not much clarity for 2021. Now we're gaining clarity because we know a vaccine is coming. Well, now money is going towards these stocks, and this is lifting the index higher. So it's actually a very good thing to have that breadth, and valuation needs to be taken with a grain of salt. When you look at asset allocation, so I discussed equities now. Asset allocation, I always say it's a relative game. So there's always an idea there if something goes well, when one other asset class will be under pressure, and vice versa. So when you look at equities versus bonds, this is the most important decision that we have to make. There are also many small decisions around that, but this is the most important call. Well, you need to allocate money mostly to equities or to fixed income. You need to be overweight one of the two. Well, here you have a very important concept, the equity risk premium. This is for the S&P 500, so the blue line. So the equity risk premium is, there are two things there. There's the earnings yield. The earnings yield is nothing else than the inverse of the price earnings. So just for example, the stock of company XYZ, and you buy it for $100, and this company makes $10 a year of profits. So that would give you an earnings yield of 10%. So for every dollar that you invested in that company, you get a share of the profit, which is 10% of the money that you put in. So very similar to the same thing when you buy bonds. You buy bonds and you say, well, the coupon is about X%, let's say 1%. So that means that for every dollar that you put there, you'll get returns of about 1%, capital gains plus the coupon. So you can, when you look at things this way, you can compare how equity is expensive compared to bonds. The equity risk premium is nothing else than the earnings yield minus the interest rate. So when the line is high, that means that equities are cheap compared to bonds, and when the line is low, that means that equities are expensive compared to bonds. And now, as you can see, we were very, very cheap compared to bonds on the equity side during the worst of the crisis, and we've made some headwind already, but we're still pretty cheap compared to bonds. So reason is that interest rates are very low, so that makes bonds expensive. And when interest rates are so low, distorted by central banks keeping interest rates low, putting liquidity in the markets, so that helps equities too. So you have a very good environment for favoring equities over bonds. So that was the blue line. The gray line is the economic policy uncertainty index. As you can see, there's a pretty good relationship between the two, and we'd be willing to bet that with Mr. Biden coming in and Mr. Trump leaving, that you should have more less economic uncertainty in 2021. So this would also favor an outperformance of equities over bonds. So that means that you'll have equities performing strongly or bonds performing bad, or a bit of both. So this is what we're looking at in 2021. This is what the environment favors.
So bottom line that with interest rate very low, depending if they stay very low, but maybe less uncertainty under Biden administration, because it will not be policy on the fly with the tweet at 11 o'clock in the evening. It would be more the World Trade Organization, more predictable environment. That suggests that it's an environment who should favor equities. That's your story.
Yep. Yeah, exactly. So in 2021, that doesn't mean that you won't have any volatility. You will have volatility along the way, but we think that when 2021 is said and done, that you'll have higher returns from equities than from bonds, from fixed income. So we will be favoring an overweight on equities and an underweight on bonds on average during the year. There will be some trade-offs, there will be some volatility, but this is the strategy that we are looking to adopt in 2021. Speaking of interest rates are pushed slowly higher by news on the vaccines. Since we've had the announcements, we've had a few Monday mornings with the news on vaccines recently. Well, the 10-year rate in the US slowly pushing higher on the left, so it's not an explosion, but it's still pushing higher. And on the right, you see that the curve is steepening. So this is the spread between the 2-year and the 10-year in the US, so it is steepening. So when you have a steepening of the yield curve, it tends to have very important consequences in equities. So of course, this is a very strong headwind for fixed income in 2021. But when you turn back again to equities, well, steepening yield curve, the best example is banks. Banks are viewed as value stocks, so it helps value. And think about banks. If you have higher long rates and you have lower short rates, well, they tend to borrow short and to lend long. So that means more profits for them. So that helps them. So this is just an example, but value, maybe it's time for value to outshine growth. And just the title was picked carefully. It's not that sell growth and dive deep into value. It's now maybe time for value to outshine growth. On the left, you see that value over growth has been a losing proposition for a while. Let's say for the last 10 years, growth has outperformed value by a very strong margin. And there's a reason for that. And you look on the right, you see those are the profits. And when you look, the green line is the profits from the growth sector, and it's being shooting up like an arrow. So think about all of the big tech sectors, tech companies, the healthcare sector. So they've been making lots of profits. So it's not that it's speculative. It's not like the dot-com bubble that everyone's buying companies that don't make 1 cent of profit. There's a lot of profits in growth, but value has been unloved. And with a steepening of the yield curve, with a better economic backdrop, you could be in for an outperformance of value over growth. So as I mentioned, that doesn't mean that growth will have a negative year. That means that value should outperform it. And already it's starting to happen. During the month of November, we've seen some spurts where value had its best outperformance over growth since 2009. And look, it's just a little bit of the rebound that you see on the right of the left-hand chart. And so there's lots of potential for outperformance of value over growth. So value over growth, this is sectors. It has implication for sectors. So banks, oil, gas, resources should be helped by this, but it also has very strong implications for geographical asset allocation. So emerging markets, European markets, the TSX, so the Canadian market, are fairly heavy in value when you compare to the S&P 500. So we are expecting a geographical rotation in 2021. And just look how cheap everything is now compared to the US. So on the left, you have the emerging markets relative to US, and the same chart would have applied if you had looked at the TSX, or pretty much. On the right, you have European equities compared to the US. So this is a even longer 100 years, but look, since 2010, the S&P 500 outperformed everyone. So we could be in for a return to the mean, so an outperformance of EM, Europe, Canada versus the US stock market. So this is why we are recommending, and we are positioning this way too. If I look at the strategies here, to overweight Canadian equities, international equities, emerging markets equities, and not overweight the US stock market. So in the short term, on the left, you have the tactical asset allocation. We go even as far as saying that it's a good idea now to be slightly underweight. That's a strong underweight, but slightly underweight US equities, because the market has done a lot, outperformed again, especially on the NASDAQ. You have close to 40% return. So it's a very strong year, one of its best years ever, actually. So in the short term, it might seem maybe a bit stretched, but over the longer term, being neutral the US stock market and overweight everything else for us makes a lot of sense. And being underweight bonds with less duration too, that would be a very good strategy on our end. So just to give you again an idea that when you're asset allocators, there is always an interesting trade somewhere. So if it's not equities, it's bonds, and it's something else. So relative gain.
It's a very great wrap up. You mentioned on the big picture that yes, we still have maybe permanent job losses, but overall we will have a significant rebound of the economy, to likely continue fueled by the vaccine in addition, and this easy expansionist monetary policy, very expansionist interest rate zero, and the asset mix. Even if equities has performed very well, if you check valuation and compare to the bond market, equities are still attractive, and we will have an environment more predictable under Biden. And finally, value probably grow over the long run, but probably in 2021, value outperform growth stocks. And if it's the case, US probably underperform because they have so many growth stocks compared to Europe and Canada. So it's a great wrap up. We have time running, and maybe if you can spend a few minutes, since you're a portfolio manager, you collaborate with me on the diversified funds, but you're lead portfolio manager on some other management like focus and selection. Maybe a few minutes to explain this different I manage solution, and we'll go to Q&A after that.
Sure. So it's a good idea now, a good time to just maybe compare everything. So and go back to the performance too. So how to differentiate them? So here I brought the main segregated fund series. So we also manage mutual funds with Clarington, but I wanted to focus on the seg funds for today. So the main four families, so diversified, that you've known for many years. These were the first funds that were given to us in early 2013 when we arrived. Global asset allocation, and you have selection, and you have focus. So I'll start with the diversified funds. Diversified funds, they're Canadian funds. They're only Canadian funds on this panel here. So this differentiates them right there. There are no external managers, so it's only internal IA managers in there. It's always been that way since we've been with IA for the last 8 years, and it's very tactical. So what we do is that we tend to use between 15 and 20 to even 25% of the fund. We use ETFs and we use derivatives, so futures. We use commodities like gold, and the best ideas that we have, we put them in there. We are very active, and it paid off when we had the COVID situation happening in March. We're able to very quickly remove lots of risk from the portfolio and had lots of risk when we thought it was the time to do so. And risk management is very easy because it's kind of a kitchen sink approach. Every tool that exists, we use in the diversified funds. Global asset allocation funds are kind of the parent fund to diversified. Less active, but still tactical management with the use of ETFs, but those are global funds. We use internal and external managers, but what differentiates them the most is that we include alternative assets, and there's about 15% of alternative assets in there. So usually you can always get that, through the big pension funds, but we decided to offer that to our clients through a seg fund solution. So this is the global asset allocation funds. The two families on the bottom are the ones that I manage personally. So if I start with focus on the bottom right, those are global funds, just like the new selection funds, which were revamped this year, but the focus funds were revamped in June of 2019. So now they're global funds, they're rebalanced monthly, and they incorporate internal and external managers. So for example, you have Dynamic in there, you have PIMCO in there. So if there are some outside managers that you like, you'll find them in focus. They are passive in its asset allocation, so there's no asset allocation calls in there. They're focused on the choice of underlying managers. So we made a very precise choice, and we update it regularly, of having the best managers to make the most out of the market and to have good, solid diversification. So it's not every manager that has the same style that's in there, and we don't use ETFs or derivatives. And so far, we've had a good year, a good run. We'll go into the results in a few minutes. Selection funds, they were revamped also, but this year, and the final part of the revamp was done actually at the close of October 27, 2020. So it's very fresh, but we started revamping them through the summer, and now they are global funds. Before they were Canadian and global, so there was a mismatch between the funds and the peers on Morningstar. So that's why you could see some funny results when you look at the Morningstar result for selection funds, but now they're well aligned with the categories, internal and external managers. So we have managers from IA, and we have two external managers. So you have Will Dana from Fidelity that was added there, and you have Loomis Sales for bonds. So when I say global concentrated funds, is that we look to have around 6 portfolio managers to make a whole complete solution with. So we want to have the selection of the best portfolio managers that IA has to offer on its platform, whether it's internal or external. So you only have the best performing managers there. So if for whatever reason one of our portfolio managers start to underperform because his style is out of favor or any other reason, it won't be automatic day one, but we will be looking at maybe replacing this portfolio manager and always keep the best performing ones in the selection fund. So that's how we differentiate it. So strategic management, that means that when you look at the table I presented earlier about the tactical move 0 to 6 months and 6 to 18 months horizon, we tend to stay on the strategic long-term approach, but with some opportunistic tactical moves, and we can do that through derivatives. So if we think for whatever reason just right now that, well, yes, we want to be fully invested in the US stock market long term, but in the short term it might be a bit too risky, well, we can adjust for the short term and then get back to the strategic position that we want. So the importance is that you know how to differentiate them, but also we're not omniscient. So sometimes if we want to make sure that if we make a mistake, it's not every fund that suffers from that mistake. So we want them to be differentiated. So here, the gross returns as at October 30, there's 2019 and there's 2020. If you look at 2019 first, last year, everyone could look at that and say, well, pick any family, you're going to get exactly the same result. Well, last year, volatility was so low during the year that any strategy, passive, active, it was hard to add more value, so it was very similar. 2020, we had lots of volatility, a historic dose of volatility almost. So that shows you how they differ. So first, diversified funds on the top left, very good performance because we had all of the tools to manage risk and to be opportunistic during the volatility that was caused by the COVID situation. So we're very happy with the result there. Global asset allocation on the right, the presence of alternative assets was very helpful to give some good results and to stabilize the results. So we're happy with the result that it gave. Bottom right focus, the rebalancing monthly was really helpful to take advantage of the volatility that we had early in the year. So when bonds became very expensive, we were selling bonds and buying equities, and when equities rebounded, there was some good profits taken along along the way. So that gives you interesting results there. And when you look at the selection funds, before the revamp, liquidity was always an issue, and it was hard to do some tactical moves during the COVID situation. So they started to lag a little bit. But since we've started updating them since early June, the results, when you compare them to the peers in Morningstar, you'll see that the performance has turned around quite a bit, and we're expecting some very good things from selection going forward. So that gives you the main differences between the four largest, the family of funds that we have to offer, and I hope it helps you differentiate them and know which one suits the needs of your clients.
So great wrap up. You have explained very well, in fact, the different characteristic for each different money solution, because at some point people look like confused, but this is different, and it's probably a great news because it's a different strategy. So maybe some family fund could have a difficulty one year, the other will outperform, or the opposite could be true as well. So, and some who are more tactical and the other. And at the end, the gross performance is, in fact, they have two contributions. They have the contribution from the bottom up, from the portfolio manager, but they have a contribution as well from the top down on the asset mix decision, or maybe some tactical move, whatever is bullion or some ETF on sector. So great. Time is running. We go to overtime. We have a lot of questions as well, Sébastien. So first one, do you believe that inflation will finally start to show up in the coming years? What will be the reason, and what will be the implication on the asset mix?
Sure. So inflation, of course, should be rising because it's very low right now. So, but when we say inflation show up, maybe inflation of 2-3%, we could be going there in a few years. But for those that have a few gray hair, I don't think we'll see inflation just like we did in the 70s or 80s anytime soon. So many factors point towards more inflation. So first, the economic outlook is very positive. So more growth will lead to more inflation at some point. So there's always the getting back to full potential, and after that, but still growth will be pushing inflation higher. We know also that for the protectionism is pretty much here to stay. Mr. Trump did lots of protectionist moves, but this morning we had some excerpts from interviews of Mr. Biden, and he said that he won't at first, we'll see, but at first he won't roll back the tariffs on China. He won't change the phase one trade deal with China, and he's talking about investing in America first. So it's not make America great again, but it's not America first, but it's investing in America first. So you're starting to see that the protectionist tone will remain in place. And also when we reopen completely, of course, there will be some measures put in place to make sure that we don't fall into another pandemic like we did before. So that might mean more distancing, let's say, in factories. So probably you'll have a cost push there effect after that. So for us, if you see more inflation coming, that will lead us to take a better look at probably your real return bonds. So real return bonds are protected for inflation, and they tend to outperform when you have an inflationary push. Gold that we've used extensively in the past few years for geopolitical risk management and also for capital gains. Well, it might be a good idea to still hold gold, but for a new reason to protect the portfolio against inflation.
Okay, so another question is Elio. So I will read slowly. From an investing in the Canadian market point of view, you have a ham trouble. So you have some trouble with the oil and gas sector and the cost of producing oil and gas in Canada, and the banks are involved in that sector. Do you see that trend an issue? How important is the oil and gas sector now in the TSX, and is it something that could derail the Canadian funds over in 2021, for example?
Well, you're right to be concerned about the sector because you can start to see a future with much less oil. And I mean, even where we are based in Quebec, we're hearing that 2030, 2035, they love that no car that is not electric be sold. So you can start to see kind of an end game coming there. But the Canadian producers are low-cost producers. So the oil sands, it takes a lot of money to start the project, but when it's started, it's a low-cost producer. So what's already there should be okay. But the weight on the TSX is much lower now. I haven't checked in the last few days, but I think it's between 10 and 13%. So correct me, Clément, if I'm wrong. Yeah.
You're
So
right
it's very low, and it was head-to-head with technology, and technology is a lot of that is Spotify in Canada. So the energy sector is pretty much is getting close to being as important as Spotify is to the TSX. So it's less and less important. So the economy is one thing, the market is something else. If there are some real trouble on the oil sector, on the economic regional impact are more important than on the TSX because it has shrunk very much more, and we're getting more diversified on the TSX. So it should be less of a headwind than it was, let's say, 5-10 years ago.
And the fact they have referred to the lending or the reluctance, banks' reluctance to lend oil and gas sector, but at the same token, right now you have a central banks backstop corporate bonds, a federal government because it is a strategic asset. So I don't have too much concern about the ability of oil and gas, in fact, to survive in the environment because we have a uncharted territory. Federal Reserve is a backstop on the cruise line. Federal government and Central Bank of Canada are backstop on oil and gas sector. Make me no mistake about that. So another question, Canadian dollar, any view?
Yeah, I think the Canadian dollar should go higher. Mostly, for first reason is that the US dollar should be lower. Market is concerned about the twin deficit, so the fiscal deficit and the trade deficit in the US. It's not going away even if we change the administration. And in fact, we could have more deficit because now Madame Yellen, which was the Fed chair recently, when she was at the Fed, she was pushing for more help from fiscal, and now she'll be the Treasury. So she will be the fiscal policy. So we should be seeing more stimulus there. The US dollar is also quite expensive on an historical basis, so there's a headwind there. When global economy does well, usually that pushes the US dollar down, and that pushes the Canadian dollar higher. And there's still lots of unknowns. A vaccination campaign that's coming could be even stronger boost on the economy than we think. If that is the case, the Canadian dollar could return all the way to parity, purchase power parity, which is 85 cents. I don't mean parity 1-to-1 versus the US dollar, but I think it would be safe to assume that between 80 and 82 cents would be a good trading range for the Canadian dollar as we go a bit deeper into 2021.
A question from Luke, I have to say. So with this low bond yield environment, with some funds like security funds or modern law, diversified security, the nickname the modern law fund, and look like not very attractive for the next 2 years. So any reason or rationale that people could think about diversified security?
Well, if you look at a good example is the slides that I showed earlier about the returns on our families of fund. The biggest return in 2020 among all of our funds was in the focus ones and the most prudent ones. So lots of fixed income there. You need to be opportunistic. You need to have the right managers. So of course, even if interest rates move higher, they'll be using more corporate bonds. They'll be using some floating rate. As I mentioned earlier, we might be using real return bonds. So there is always a way to protect even the portfolio, even if there's a headwind from rising interest rates. You always need bonds in a portfolio because when there's some volatility, you want to have this protection. Of course, we will be running underweight bonds during the year, so that will be protecting from this headwind. But don't think that since interest rates should be moving higher, that you should be going too aggressive. You always need to know your client and respect their risk profile. And fixed income is it's a vast universe, and it's not just the federal bonds. There are many options there to add value, and our managers have proved that they can do that.
And you can be active as well regarding the fund duration, because you have the possibility to have a high yield. So high yield is more risky at first glance, but if you don't see any recession, it's a rebound economy with a lot of liquidity. High yield floating notes offer a much better, much higher yield than the government bonds, and you have the ability, and you have some floating notes and high yield in the different funds. In the diversified security, you could have some bullion as well, exposure. So this is an area that could you offset if you want. So bottom line is not to invest only in the government sovereign funds at 0.5 or 1%. It's invest in corporate bonds, high yield, emerging bonds as well. So this is a way to diversify. So it's already 40 minutes left, so that not left, but we have done. So we have to respect our commitment to try to see to do that in 40 minutes. So very mission accomplished, very well done, Sébastien. So thank you. I think that people appreciate as well the fact that you have explained the different managed solution, the SEC funds. I know you manage as well mutual funds. So that explained quickly the differences. So this is already the end of our iAIM fall series. Hoping that you have enjoyed. I want to thank you, Sébastien, not only for today, but I have to thank you as well for the previous edition, because people may be not aware, but Sébastien being the backstop. If anything went wrong, Sébastien was there, in fact, to continue the webinar. So it's in English and French. Keep in mind that for people who has missed the beginning or problem, or technical problem, all of our edition webinar is on the iAIM website, the iAIM Economy. So you could reach the replay of that, and you have access to the chart as well. I want to thanks as well the IT people, Jean-Pierre and the colleagues who has made this that possible, as well as Caroline Rodrigue for all the, in fact, the invitation and the logistic around that IR. So hoping you have appreciate the format. So let us know. And we will have, as you know, on the weekly basis, the weekly capsule that will follow Sébastien or myself regarding the economy. And since it's probably maybe the last, it's the last edition, I want to wish you a very nice holidays, and it will be different format than this year. So take care of your family, and thank you again, Sébastien.
Thank you, everyone.
Okay, bye everyone.